It's my great pleasure to welcome you to the seminar today, and also to welcome the main speaker at this seminar today. We do have an exciting and indeed a contemporary seminar today, looking at some of the issues touching on the onset of COVID-19. But before I talk about the subject, I think it is great in order to give a warm welcome to Robert Lensink. Robert is an extraordinary distinguished researcher in our field. But also, let me start by saying that the Center for Global Finance at SOAS, University of London, is also another home for Robert, because he indeed an external research fellow at the Center for Global Finance here. But to give him the full description of his distinguished career, I will start by saying that he's one of the eminent development economists with specific interests in finance, gender studies, impact analysis, which he has been very active with, especially for a graduate level training and supporting institutions all over the world in Africa, microfinance and rural development. His full-time position is a professor of finance at the Faculty of Economics and Business at the University of Groningen, which is also my other home in many ways, over so many years. So I've had the pleasure of working with Robert for decades, not years, but actually decades, and with him, very prolifically produced some main work. But in addition, he's also supporting many organizations in the world. He's, for example, Professor Extraordinary at the University of Stellenbosch in South Africa. He's also leading in terms of research grants, which he had garnered very, very, very well over the years. He's leading in his own university as the Vice Dean Research in the Faculty of Economics and Business at the University of Groningen. And over the years, as I have the benefit of saying that I have known him over the years and we have grown old and young together, is that he has a very wide international network, in which I'm one of the international network, and also associated with like associate researcher at the Center for the European Research in Microfinance, University Libre de Brussels, resource persons of the African Economic Research Consortium in Group C, together with a number of people here, including Hongbo and including Bo Jo at Linköping, and supporting, therefore, the African Economic Research Consortium in its remit of funding and mentorship of researchers in Africa. He's also a full member of the European Development Research Network and a member of the steering committee of NWO or WOTRO, which is one of the, again, international networks. Indeed, he's been prolific. I don't know how he does it. He might tell us his secret, but he's been so prolific, producing so many high-tier papers over the years, non-stop. Almost a paper springs out of his work almost every week. But he's hit the most peer-reviewed journals with the tune of more than 120 papers in top-tier journals like the American Economic Review, the Economic Journal, the Journal of Public Economics, psychology, journals, British Journal of Social Psychology, Frontiers in Psychology, managerial science, management science, and of course also some of the mainstream journals like World Development. He has authored 4 books and edited so many books, some together with me, or some including some of my chapters over the years. So, in one word, we welcome you, Robert. We are fortunate and honored to have you here in your distinguished role as a contributor. And the final one is, of course, he was knighted by the Dutch government. We got an honor to which I joined him to celebrate in Groningen. So today he will be sharing with us some of the experimental work in which he's been, very active. Some of the experimental work in South Africa, and during the ESRC research project in which he was co-investigator, he was very active in some of the other experiments he did in other parts of Africa. But today he will be sharing with us the preliminary findings from the experiment work in South Africa on savings. Robert, I think at this juncture it's my great honor to invite you to start the presentation.
Thank you very much, Victor, for your very, very kind words. And indeed, we've grown all together. But thank you very much. It's a great pleasure to present this co-authored paper at the SOAS seminar. It's a little bit of pity that I couldn't come over to SOAS, and I very much would like to have a possibility coming over to SOAS in the coming year. And now COVID problem is going down. So, but anyway, I'm very pleased to be able to give this presentation here. This paper is a co-authored paper. It's actually a work in progress. It's a co-authored paper with Amy Janssen. Amy Janssen is actually a part-time PhD student of mine. She's partly based in Groningen at the University of Groningen, but for the main part she's based in South Africa and working at a bank, and it's at her bank that we did this experiment. So to give you a little bit an idea about what the paper is about and about the context, what we do in this paper is we describe a very simple experiment that aims to increase savings of clients of this bank. So more specifically, we test the impact of a reminder message, a text message that has been sent to a sample of clients of this bank, a big sample of clients of this bank. And I will give you more details about the text message later. So if you look at the literature, especially on financial inclusion, there's a type of literature I try to contribute to a little bit, and like me, many others, like Victor and others at SOAS. If you look at this literature, then you see that there is an increasing interest in the importance of savings. So there was already a lot of attention for credit, but maybe the last decade, people start to do research and talk about the importance of savings more and more. And the reasons I think are clear. Accumulating savings may help to increase investments, which may enhance productivity. Savings may help to smooth consumption over time and thus manage income fluctuations. And finally, accumulating savings can offset some of the unexpected yet inevitable income shocks due to, for instance, draws, health problems, etc. So for these reasons, there's been many attempts and many experiments where researchers and practitioners try to incentivize people to open a savings account or to save more on their existing accounts. Now, what we've seen in this literature is that the experiments in general were quite successful in inducing people to open a savings account, but it turned out to be much more difficult to induce people to use the savings account and to increase the amount of savings on an existing account. So therefore, there's a couple of experiments going on where they try to specifically focus on people who have a savings account and try to incentivize them to increase the amount of savings. One of the authors in this field is Dean Carlin, and he and a group of his co-authors focused very much on different experiments to try to increase savings behavior and savings of clients of different banks or microfinance organizations. And one of the things they did is they did a couple of experiments with so-called reminder messages, and in a couple of studies they showed and provided kind of strong evidence that reminder messages might be a very good instrument to induce clients who already opened the savings account to save more and more regularly. Now, following studies by Carlin and others, the aim of this paper is actually very simple. We wanted simply to experimentally test with a South African bank whether sending reminder messages to a sample of the clients would also induce those clients to increase their savings behavior. And if you, a little bit maybe for the context of the paper, Carlin, in his papers, proposed a kind of an attention-based model to explain why reminder messages might increase savings. In his model, attention refers to the likelihood that an agent or a client remembers an unusual expense in the future, which might have higher utility than regular consumption. So what happens in his model is that if an agent remembers the expense that she will save for, or she will not save for it. Not saving for the irregular expense in the future will have as a consequence that this irregular expense cannot be done, or that later in time people have to reduce regular consumption to somehow fund the irregular expense. And that normally will lead to a decrease in utility. And what he showed in his model is that by sending reminder messages about this, the irregular expense people need to make in the future, people might remember the future expense they have to do and therefore start saving for it now immediately, and that will probably lead to an increase in savings and an increase in utility. Now, this is the kind of setting we were in and which we wanted to replicate for South Africa. However, when we started this experiment, and we were just started the experiment, the COVID crisis started. And South Africa ran into a period of quite severe lockdowns. Now, what we show in this paper is a couple of things. It's first that we do the experiment and the empirical results have completely opposite results as what the normal reminder study showed. What we do find is that the reminder actually led to a decrease in savings.
Sorry, Robert. On my screen, I can see the front page only.
Sorry?
Are you still on the front page?
I'm still on the first page, and I go on. So
Okay.
So no problem. I just give context.
Yeah, sure. Okay, go ahead. Yeah,
it's no problem.
Yeah.
So what we will show here, and I go into the details and the models in a minute, is that our experiments showed that the reminder messages led to a decrease in savings instead of an increase in savings. So what we try to do in this paper is not only giving, let's say, the empirical results, but also trying to find an explanation of this by kind of making a very small adjustment to the standard theoretical model of Carlin. So this is a little bit the context of the entire paper, and now I'm going to try to give you a bit more details and try to explain a little bit more in detail what I've now set in general. So what I said, my co-author from this is Amy Janssen. My name is Robert Lensink. We're both based at Faculty of Economics and Business, University of Groningen. But Amy is mainly based in the South African bank where the experiment took place. So what I do here in the presentation, I start with presenting a simplified standard reminders model, a simplified model in line with the model by Carlin and other authors who've worked on this type of models. And I will show you that this in the simplified standard reminders model, reminder will increase savings. Next, I will go to the experiment we have done, the empirical experiment, so the empirical study in South Africa. And I will show you that our experiments led to the opposite result. Reminders actually reduce savings. And then finally, I come back to the standards reminders model, but make propose a few adjustments to the theoretical model, which might explain why during periods of crisis, a reminder may lead to a decrease in savings instead of an increase in savings. So what we do is we suggest that reminders may reduce savings during an unexpected crisis periods, and when reminders make past wealth accumulation more salient. So we will make two kind of adjustments to the model. First, we will adjust the model for an unexpected crisis. And second, we will adjust the model by assuming that people may not only forget future expenses, but may somehow also forget past wealth accumulations. Now, and if you introduce those two adjustments, then reminders may actually reduce savings. And that's what I tried to, was kind of the argument of this paper. Now, it's a very short paper and the models are very simple, but I will anyway go through it and try to explain it step by step. Now, let's start with the standard reminders model, first in words, and then in a few simple equations. It's a very simple model. The model, as I said, is based on a more sophisticated model of Carlin, but we try to make the model as simple as possible, and but the model still does what it comes to the same conclusion and implication as the more sophisticated model by Carlin. So what we assume here is that you have an agent, different agents who save, but that, or may save, but the agents may not be attentive to all expenditures. So they may forget some type of expenditures. Now in the model, we assume that there are two types of expenditures. There's regular consumption, just normal consumption goods, but there is also a future discrete expense, something you may need to make in the future. Maybe you have to pay for school fees, you have car repayment expenses, a kind of a festival, a wedding or whatever. So you have two types of expenses. Regular consumption every day and some future irregular expenses which will come up for certain, but is another type of expenditure. Now we assume here that agents are fully attentive to regular consumption, so they don't forget it. In period 1 until the future, in every period, they will remember that they have to do regular consumption, to make regular consumption. So they will not forget that. But there is a possibility here that agents are inattentive to future discrete expenses. So implying that at period 1, they forget that at period 5 or 3 or 4 or whatever period in the future, they need to do a kind of irregular expense. Maybe they have to pay for a car repairment or whatever. But consumers may forget that. So agents here will not forget to plan for regular consumption, but may forget to plan for future discrete expansions. So what happens then, if they forget, then savings will be low or too low, as future expenses are not taken into account. So if you forget your future expenses, you don't save now for your future expenses. Now, what the reminder message here does is if people do get a reminder, very simply, the reminder just reminds them on the fact that, hey, don't forget that after 2 years you have to pay some expenses for your car. This may induce people to save so that they don't forget about the future expense and therefore will save. So this is basically the models. So reminders will then increase savings and also welfare if the irregular expense have higher utility than regular consumption. So this is basically the simple standard reminders model. Now a little bit in equations. So what we've done, we reworked the model in the most simplest way as possible. So we take a 3-period models, and agents derive utility from regular consumption and from discrete expenses. Now we assume that utility from regular consumption is given by a normal utility function U over C. And the utility function has the usual characteristics. It's increasing in regular consumption, and the second derivative is negative, so it's a concave utility function. Now, the regular consumption is denoted by the variable C, and the irregular consumption is denoted by the variable X. And we assume that the irregular expense has a utility, if it has been made, equal to U bar. So an agent who makes a discrete expense receives a utility equal to U bar. And this is a kind of a discrete choice. So the discrete expense will be made or will not be made. And the regular consumption is a continuous variable. But that's not so important. Now, then the consumer agent maximizes utility, and we have a very simple utility function, a so-called additive utility function. We have 3 periods. The irregular consumption will only be available in the 3rd period, the regular consumption in all periods, and we have additive utility, which implies that we can simply sum the utility of the 2 types of consumptions, and then you get the simple expression which is given here on the sheet. Now the parameter theta is a binary variable. The consumer will make or will not make the future irregular expense, and if the agent makes this irregular expense, then the utility will be U bar. We assume that in each period, the 3 periods, the agent receives a constant income equal to Y in all periods. It makes the model very simple. So there are 3 periods and there's just exogenous income equal to Y in all 3 periods. Now, to make the model even more simple, we assume that the agent doesn't discount the future. There's no interest on either borrowing or saving. So the model becomes very simple. Now we can very simply introduce a discount rate and interest rate on savings or borrowing, but the main implications of the model will not change by this. Now, an important assumption here is number A6, where we assume that it is worthwhile to make the exceptional expense in period 3 by foregoing amounts of ordinary consumption in the 3 periods. So maybe a quick word on this condition here. The left-hand side of this condition is the utility you get if you make the discrete expense. That's the left-hand side. The discrete expense can be made only in 1 period, period 3. Now, people can save 3 periods for this discrete expense, and if an agent makes the discrete expense, the cost of the discrete expense is equal to 1, so unity cost. Now, the agent gets in every period a income of Y and can spend some income on consumption, or all income on consumption, or save for a next period. So if the agent decides to save each period 1/3, then the agent will save enough for buying the irregular expense in the last period. So if the agent doesn't save, so uses entire income for regular consumption, the utility will be U over Y. Yeah, so that's just the utility of the consumption, regular consumption of 3 periods. Now, if the agent saves every period 1/3 in order to fund the irregular expense, then the utility will go down by U over Y minus 1/3. So the utility decrease of saving for your irregular expense equals UY minus UY minus 1/3. Now, if the utility decrease is smaller than the increase in utility of making the discrete expense, then it's worthwhile to make the expected expense in period 3. Yeah, so that's this condition. So it's just worthwhile to save for your exceptional expense. Now, the last one is just an assumption to close the model. We assume that in period 1, at the beginning of period 1, there is no wealth, and at the end of period 3, or beginning of period 4, there's also no wealth, so all savings or borrowing within the 3 periods will, all borrowing will be repaid within the 3 periods, and all savings will be spent in the 3 periods. Yeah, so it's a very extremely simple model. Now we start with a kind of a benchmark. So if you have a full attentive agent who doesn't forget about regular consumption, but also doesn't forget about future irregular consumption, what is then the case? Now, so assume that the agent has perfect foresight and fully anticipates regular and discrete irregular expenditure, then under all the assumptions, the utility maximizing choice for the problem are that consumption in period 1, consumption in period 2, and consumption in period 3, which is the regular consumption, equal Y minus 1/3, and the irregular consumption in period 3 equals 1. Yeah. So this is the utility maximizing outcome, and the proof of this is extremely simple, because what the agent does here, it simply maximizes the utility function over 3 periods, subject to the wealth constraint, and then the outcome is immediately clear, because what we have here is we have a concave utility function for ordinary consumption. Now, the implication of a concave utility function is that people maximize utility always by smoothing consumption over time. So if you have a concave utility function, you don't want to have any variance in your consumption. So the immediate implication of the concavity of the utility function here is that agents want to smooth consumption over time. In other words, they want to have the same consumption level in every period, which is a standard kind of neoclassical outcome. Also here, the irregular expenditure shock of 1 would also be financed by smoothing the unit cost of irregular consumption over 3 periods. So the only possible utility maximizing outcome here is that consumption in period 1, 2, and 3 is the same, so it's completely smoothed, so there's no variance. And you also need to pay for the unexpected expense in period 3, so consumption simply equals income in every period minus 1/3, because in each period you save 1/3 for your irregular expense in period 3. So that is a very simple, kind of standard utility maximizing outcome of a neoclassical consumption model. Now, suppose now that the agent fully anticipates regular consumption, but is inattentive to discrete irregular expenditure in TS1 and TS2. So in TS1 and TS2, the agent forgets that in TS3, he or she needs to make an irregular expense. So she simply forgets about it. So when this agent starts to plan his consumption level in period 1 and 2, then at the beginning of period 1, it sets consumption in period 1 and period 2 again at the same level, because it's a concave utility function. So the agent wants to smooth consumption in the 3 periods. So the agent sets consumption in period 1, 2, and expects also consumption in period 3 to be the same at level y. But what happens if period 3 arrives, then suddenly the agent realizes that she needs to do this unexpected of the irregular expense of 1. So consumption in period 1 and period 2 was already y, but in period 3, the agent suddenly realized that an expense of 1 needs to be done. So consumption in period 3, regular consumption, has to go down by 1. So consumption in period 3 becomes y minus 1, and x3 in the last period equals 1. Yeah, so that will be the outcome when the irregular expense in the last period is also welfare increasing. Another possible outcome would be that also in the last period, the agent sets consumption equal to y, but then there will be no money available anymore for the irregular expense, and the irregular expense will be equal to 0. Now, in both cases here, utility will be lower than utility obtained by the fully inattentive agent. Now, the proof here is again very simple, because inattentive agent sets consumption for TS1, 2, and 3 by optimizing utility without considering the irregular expense. Due to the concavity of the utility function, the agent sets C1, C2, C3 equal to y. And when TS3 arrives, the irregular expense needs to be made, and the irregular expense will then be funded by consumption in TS3, or will be foregone completely. Now, irrespective of the outcome, the utility will be lower, and the reason here is again is the concavity of the utility function and condition A6. So the concavity of the utility function implies that the fully smoothed consumption over the 3 periods will be preferred over the situation where you have to do the irregular expense in the last period, because then regular consumption in period 1 and period 2 are not the same as regular consumption in period 3, so you're not completely smoothed out. Then, in this extremely simple model, what happens with reminders? What we assume here is again a situation that the agent fully anticipates regular consumption but is inattentive to discrete expenditure. But now we introduce a reminder, and the reminder is kind of a perfect reminder, ensures that the full attention outcome will result. So the reminder helps people to remind about the future expense. Now, if this works, then the data will be equal to 1, and we are back in the model with full attentive expenditures, and this, of course, will then lead to an increase in utility, and because now people are going to save in each period for the irregular expense in the last period, this will lead to an increase in savings. Now, it's a very simple model, but this is kind of the implication of this model. So once again, the idea is very simple. People may forget that they have to do a welfare increasing irregular expense in the future period. They forget to save about it. Now they get a reminder, somebody sends them a reminder about this, and then people will not forget it anymore. And then they will save each and every period, which will increase utility and lead to an increase in savings. So this is the entire idea. So we started with this model, and we wanted to set up actually different experiments with the South African bank to increase savings of their clients. And in this experiment, we try to increase savings of the clients by sending out a reminder. So the experiment ran from March to June 2020. So that's the time period that we sent reminders, but we followed, let's say, the behavior of the clients for a much longer period, for a period of 15 months. Now in March, when we started the experiment, just 1 week after we started the experiment, the lockdown, or not the lockdown, but the COVID became quite influencing, and South Africa had partly to go down in the lockdown. So there was a very strange period to do the experiment. Now what we did was a standard randomized control trial. So we use a big sample of clients from this South African bank. In total, our sample had more than 30,000 clients, and we randomly distributed the sample of about 31,000 clients in two groups. In a treatment group with 10,416 clients, and control group with 20,830 clients. So we wanted to have a bigger control group, but it's actually not so important here. But what you see here is that we have a big sample, so more than 30,000 clients, now randomly distributed in two groups. Now in the treatment group is the group who got on a monthly basis a text message, and the text message we sent was very simple. So there was a statement people got on their phone. So it was the bank name, the client name. It was a very simple text. Continue to grow your investments, save monthly, and move closer to achieving your savings goals. And we send this reminder 4 or 5 times, I think, in total. Now, that's all what it is. It was a very, very simple experiment. So what we did here, and this is what you always do if you do a randomized control trial, you start by testing whether the randomization worked out. So we have kind of baseline information from the sample. So there's information the bank had. So we didn't do a survey, but we had kind of characteristics of the clients, like the gender, income group, where they live, etc. And what we tried to do is, before we started the experiment, just before the experiment, using data to see to what extent the two groups on average are the same. So whether the treatment group and the control group are similar in terms of their characteristics, and they were. So there's no reason to expect here that the randomization didn't work. Now, that's also not so surprising, because we have a very big sample of 30,000 people, and randomly dividing 30,000 people in two groups, then the likelihood that you have kind of balance is very big. Now, after we did the experiment for 15 months, we got information on a monthly basis on 2 types of variables. We had a binary dummy, so we had information about savings behavior for a 15-month period from August 2019 to October 2020. So we have information before the experiment started, and a period during the experiment, and a period after the experiment. So for 15 months in total, we have savings information and a little bit of information about characteristics of the sample, but not so much. So mainly the main information we have is the savings information, and we decided to run 2 specifications, 2 type of kind of fixed effects models with 2 different type of dependent variable. In the first specifications, we had a binary dummy, which has 1 if people had positive savings, or a 0 if they haven't didn't do any savings at the monthly basis, so a binary dummy with a 1 or a 0. And for those specifications with this dependent variable, we run so-called fixed effects logic models, and we had information about the absolute amount of savings, so the continuous amount of savings, so what did people have at the end of the month at the bank account, and we run so-called OLS fixed effect models. Now the specifications are given above, so there is a reminder variable, which is a 1 if people got a reminder yes or no. There is a intervention period, a dummy for an intervention period in the first specification, and there are fixed effects at the household level. And then we have a second specification where, in addition to the reminder dummy and the intervention period, so there's the second, here there's a mistake in the equation. The second one shouldn't be remind, but should be intervention period. There we also added month dummies. Yeah, so but there are two very simple specifications, just fixed effect logic model and OLS fixed effect models. Now the specification on, and so we couldn't add much more controls because we didn't have time varying controls available, but it's also not so important here because it's a randomized control trial. So normal OLS models would be unbiased here. You would normally maybe try to add some controls to improve precision, but it's not really needed. But in our case, we implicitly added controls because we run fixed effect models. So we controlled for all, let's say, non-time varying differences. Now we run those two models over 15 month period, so that actually means that the amount of observations we had, because we had a sample of more than 30,000 people, where we have information at the monthly basis, so the total sample in the estimates is about almost 470,000 observations for the models where we took into account the absolute amount of savings. For the models where we took into account the savings dummy, so a 1 for if people had positive savings and a 0 people didn't have positive savings, the amount of observations is quite a bit lower because recall that we run fixed effect models, and here for all, let's say, agents who didn't change savings behavior over the entire period, those observations drop out because they are perfectly correlated with the fixed effect. So for the models where we have as dependent variable the savings dummy, we had about 200,000 observations, and where we have the kind of absolute amount of savings, we had about 470,000 observations. Now, in the very simple model, what we find here for the 4 different specifications is what you see is that in all outcomes, we have a highly significant negative sign. So in the first 2 equations, it means that the reminder leads to a decrease in the probability of savings, the 2 specifications. And in the last 2 equations, it means that the reminder leads to a decrease in the absolute amount of savings of the whole period. So completely opposite to what was found in earlier studies. So what we found here in these very simple regressions is that reminders reduce savings. And we were quite surprised about it, but we started thinking about what could be the reason here. Now, one obvious difference in our, let's say, experiment vis-a-vis the other experiment that was done by others is that this crisis period, kind of unexpected crisis period because of the COVID, kind of interfered immediately with our experiments. So the question we had is it maybe possible that reminders have a different role, especially during crisis periods. Because what might happen if you are in a crisis period and your income drops very much, that you start to use, let's say, savings, your accumulated savings from the past to pay for current consumption. Now, what a reminder might do then is that this past accumulative wealth becomes more salient. So the reminder might actually remind you on the fact that, hey, we do have accumulated expense from the past, which we can use to pay for our current expenses, which we need to do because we are in a crisis period. So this was a little bit the idea we had. So we tried to formalize that by making a very simple adjustment to the very simple model. And what we did is we still use the 3-period model, but we wanted to introduce a kind of a standard accumulated wealth. And what we assumed here actually to realize this is that in period TS1, that agents were still fully attentive and started saving already for irregular expense in period 3. So that we have some starting value of wealth. So we could have done this in another way as well, but the only, let's say, important kind of assumption here, or what we need to have, is a starting value of wealth. Now, we did that in this way, but can be done in another way as well. Then we brought in the model that there is an unexpected crisis which starts in period 2 and holds on in period 3. And we did this in a very simple way. In the original model, we assumed that income was constant over the 3 periods and the same level Y in period 1, 2, and 3. And we now simply assume that suddenly income in period 2 and income in period 3 becomes smaller than income in period 1. And the agent who plans for the future doesn't take this into account in period 1 because it's an unexpected decrease in income. Now we also introduce the possibility of forgetting your past accumulated wealth. So in the original model, there was a probability of forgetting theta I sub I with respect to the discrete expense in period 3. So people could forget, could be unattentive to the discrete expense in period 3. Now we assume here that people may somehow forget or normally not use it, the accumulated past wealth from the past. So we introduce a new parameter theta sub j. So in other words, very simple adjustment. Agents can forget future possibilities and past actions. Now what happens in this, again, very simple model? Now first, it's maybe good to look at the immediate effect of a crisis. So if you are an inattentive agent, then you need to decide in period PS3 whether you will make the irregular expense, yes or no. Yeah, so recall, if you're inattentive with respect to the future, you make a plan in period 1, you forget about your irregular expense in period 3. So when period 3 arrives, you suddenly need to make a decision whether you will still do this irregular expense or whether you will not do it. If you do the irregular expense, then you need to reduce regular consumption in the last period. Now, when this happened, you need to look at the following condition, whether the additional utility increase of doing the irregular expense in the last period, which is U bar, if that exceeds the reduction in utility due to funding the irregular expense in the last period by reducing regular consumption. So that is this simple condition. Now, if due to the crisis, income decreases, and because of the fact that the utility function is concave, this condition is much less likely to hold during a crisis than during a period with high income. Yeah, because the second derivative of the utility function is negative. So if your income goes down, this condition condition which is needed to make irregular expense welfare increasing is much less likely to hold. Now, what this also implies that it's also less likely that the unexpected expense will actually be done if there is a crisis. So, and if that is the case, then the reminder will have no effect because the irregular expense will not be made anyway. Yeah, so in other words, a very simple implication here. If you have a choice between an irregular and a regular expense, you will only make the irregular expense if the utility of the irregular expense is bigger than the decrease in utility due to the reduction of regular consumption. Now, if the income decreases due to the concavity of the utility function, the possibility that this condition holds will go down. So in periods with unexpected lower incomes, the possibility that the reminder has any impact becomes much smaller because it's highly likely that you didn't do the, let's say, make the irregular expense anyway. Now, this is good to realize. Now we look in the paper at two simple situations. First, at the situation where the discrete and expense in period 3 still remains worthwhile. So it's still useful to do the discrete expense, even though income is much lower. Now we have here 4 situations. So we have a situation on the 2 axes are the thetas. On the horizontal axis is theta sub I, which indicates whether you do remember, whether the reminder helps you to remember future expense, yes or no. So, and on the vertical axis is theta j, which is has to do whether you are attentive or inattentive with respect to past accumulated savings. Now, the let's say income or welfare increasing outcome is when people are attentive to both future expenses and past accumulated wealth. So that both thetas are equal to 1. So that's the kind of block on the right hand side where C2 is y minus 1/3 and C3 is y minus 1/3. So this is the welfare increasing outcome. So income in each and every period, here you only plan for 2 periods, T2 and C3, is the same, and you save for your irregular expense. So consumption in both periods is equals y minus 1/3, so the same in 2 periods, and you also do the irregular expense of 1 because in the first period your accumulated wealth was already 1/3, 1/3 plus 1/3 plus 1/3 makes 1. So that's the utility increasing outcome. Now, in a situation where you're not attentive to both the future and the past, then you are in situation 0, 0, the left-hand side, upper side. So when this is the case, then in period 2, you didn't think about your accumulated wealth at all. So your income, your consumption will be equal to income because you also don't think about your future expense. Now in period 3, you suddenly realize that you need to do to make the irregular expense as well as 1, and then you also realize that you had some accumulated savings, so your consumption in period 3 need to go down by 2/3 because you need to have 2/3 additional savings to make up for your irregular expense. Now what you see in this diagram, that in one case where reminders help agents to remind past savings, so theta j is 1, but not the future expense. Then, and so that should be theta j is 1 and theta I is 0. So there's a small mistake here that the savings actually in period 2 go down. So you see here theta j is 1 and theta I is 0, that consumption in period 2 becomes y plus 1/6. So the reminder here induces people to consume more and save less. And then in the last period, again, they have to make up for it because they still need to do the irregular expense. So here, the direct consequence of the possibility that people may somehow forget the accumulated expense and that reminders may kind of make this accumulated wealth salient and induce people to use this wealth for paying their regular consumption, induces people to save less in period 2 and to consume more. So this is the first outcome, and it's kind of in line with what we find. The last situation we look at is the case where, due to the decrease in income, due to the, let's say, a crisis, the expense in period 3 is not worthwhile to begin with. And that's a situation where reminders that help remind future expenses will not have any impact because the agents will not do a future expense anyway. So that you see in the last column here, so the theta I is 1. So the change the change from theta I is 0 to theta I is 1 doesn't affect consumption choices here because the future expense will not be made anyway. But what you do see here is that in the case where reminders that only remind past savings, which is the case where theta j is 1 and theta I is 0, but also the situation where reminders help to remind both past and future savings, the theta I is 1 and theta j is 1, that in both cases, consumption goes up and savings goes down. Yeah, so this is actually the case what we, which is again in line with our empirical results. So to conclude, with this very simple experiment and also very simple model, what we do find here, in contrast to earlier experiments, is that a reminder had a quite substantial negative effect on the probability of savings and the amount of savings. We argue here that this may be due to the fact that the experiment happened during a period where there was a crisis, and the crisis, the increased utility of regular consumption vis-a-vis the utility of irregular expenses, where which implies that reminding future expenses become kind of useless. And also something which may be more important during crisis periods, the reminders may make past wealth, accumulated wealth, more salient. Agents might actually, if they come into a crisis period, may, by getting the reminder, be reminded on the fact that they had some savings available and may immediately use it for current consumption, which lead to a decrease in income immediately. Now, again, this may especially be relevant if income unexpectedly went down. Now, this is where we are with the paper so far. We plan still to do some further research with this experiment, and the main thing we want to do very soon is to do different sample splits and look at different groups of agents, kind of heterogeneous treatment analysis by looking at the effect of the experiment for men vis-a-vis women and maybe for different income groups to find out for which group of people actually the reminder may have had a positive effect. So here we see the average effect. So on average over the sample, there was a very big negative effect on the reminders on the probability of saving and on saving amounts. But it may be so that this will not be the case maybe for the higher income groups. And that is something we still want to investigate in in the coming weeks, actually. Thank you very much.
Thank you, Robert. Thank you indeed for a very exciting presentation. And you presented a complicated model, but in very clear, straightforward terms. What is absolutely interesting in this work, Robert, is the way you take a given model and then with very clear results, undertake a randomized control trial, estimate the results from the data collected, get a result that is contrary to what the model had predicted. In other words, it predicted increase in savings, but we get a reduction in savings, and then explain the new results in a very clear way and give an adequate alternative interpretation on why savings reduced because of reminders. I suppose, but also you give some good insight in terms of if you change the some basis of analysis and the direction you are taking to look especially into heterogeneity. The gender equality and social inclusion is a very important perspective. It will, I think, greatly enhance the paper. Before I take some comments and questions on this very interesting work, I'd like to congratulate you on the so far the steps taken. And maybe there are also some other possible interpretations of this. I'm not sure how much this work would invoke a rational expectations interpretation of the work. Because if in Russian expectations, if the reminders are fully anticipated, okay, then they are taken into account by the agents, in which case basically the impact of reminders will be zero. They will not have an impact because they were fully incorporated in the information set they were fully expected. Of course, you generate the same results, but having a different explanation, especially on the way the utility of the agents behave. But
yeah.
Yes.
Yeah, that's true, Victor. Maybe one remark there. Yeah, that's true. But then you would expect no result. We find a negative result.
Yes. Yeah, you would expect no result, which is a kind.
And then you would expect null result, and we find a very strong negative result. So that is the, and you're completely right. If people are rational expectation perfect foresight, then there is no problem. Then reminders will not work. Of course not. But we do find a very strong negative result. So the puzzle we have is how can we explain the negative result?
Yeah. Excellent. Okay. I would like at this juncture to invite comments, suggestions, questions, because this work is elegant theoretically, has also an interesting experiment, but also I think it will have great implication for policymakers, and especially policymakers' reaction in the event of a crisis like COVID-19. That's the contemporaneous of the work, or indeed in the future a crisis that may be for us. So, comments, questions, observations, suggestions. Yes. Say, Lefile Maleka, please go ahead. Have the floor.
Good afternoon, everyone. Thank you so much for the presentation. Thank you, Prof, for the opportunity to ask a question. I appreciate the caveats that were raised initially and how you tried to keep the model as simple as possible in terms of assumptions that you wanted to test, etc. I was just wondering, on a general basis, South Africa being a bank-based economy, do you believe that the MPC policies historically and over the last couple of years may have had an impact on influencing client behavior and consequently your results in any way, and that the results may possibly not be a good representation of your results, with all due respect and humility?
Okay.
Yeah, that's a difficult a question. I try to rephrase your question because I'm not 100% sure what you precisely mean. Do you mean to say that the results we get may not be representative for, let's say, if a similar experiment had been done in another country with a crisis?
Correct, sir. Just because South Africa is a bank-based economy, and we do know that our Reserve Bank has certainly, through its monetary policy committee meetings, influenced a lot of the behavior of clients. I'm not even going to get into how diverse that client base is. So I ask with humility, not from a point of criticism, sir.
No, yeah, no. Thank you very much. I don't know. Look, so what you could say here, South Africa is a bank-based economy. That's one thing. One thing maybe differs here also from experiments which have been done in other African or Asian or Latin American countries, that the group of clients here is probably on average a bit more wealthy than the clients who were in the samples for the other studies. But that maybe couldn't explain what we find. So that I don't know. So there's maybe a little bit of a specific group of clients. Whether Africa is bank-based or not bank-based, I don't know whether that really matters, because what we do here in the experiment, of course, we look at the difference between of savings behavior of people who clients who do get a reminder and clients who don't get the reminder. So we look at the difference between similar groups of clients with and without a reminder in this data set. And I don't know whether this difference, because both the control group and the treatment group are both clients of the same bank, are both affected by the same policies in South Africa. So I find it somewhat hard to precisely understand whether, if you do a similar experiment with clients of a bank in another country, or maybe with clients who are not member of a bank but just look at normal savings behavior, at maybe informal savings or whatever, or a country which is less bank-based but maybe more market-based economies, whether the difference between the two will be different. That is, and it may well be, I don't know. Look, this is a kind of a comment which I think holds for most RCTs or RCT type of work. The randomized control trials, like this randomized control trial, is somehow good in ensuring what we call internal validity. So we are able to measure the impact of a intervention in a really unbiased way. The disadvantage of this type of experiments, and that is what you suggest a little bit here, and that may well be true, is that you always look at a specific group of people and cannot draw any far-going conclusions for other groups of people. So the external validity, as we call it, may be low. But at the same time, I do not have real reason to expect why this would be different in countries which are less bank-based than South Africa. But to be honest, I don't know the answer. So the only answer will be here if we do a similar experiment with similar type of clients, but then in a non-bank based economy. So I don't know. It may well be. So, but anyway, thank you very much for the suggestion.
Thank you, sir.
Thank you indeed, Malika, and thanks, Robert, for this discussion and further exchange of views. The second, just we invite Jaideep for comments, intervention.
For this presentation, so
sorry, we can't hear you.
Can you hear me now?
Oh yes, now I can.
Sorry for that. So yeah, thanks Victor, and thanks Robert. It was a really interesting presentation. I think it's pretty cool. I mean, the results are super strong. That you basically, from what I understood, you're telling us that people need to be reminded of their precautionary savings just as much as they need to be reminded of actually carrying out the saving in order to have them. But I was just, in terms of the controls are so clear and the results are so strong that I suppose all my questions and comments are really about like the level of degree in a sense. So first of all, I was wondering if there's any, because you checked that the randomization worked at the beginning of the sample, did it also work at the end of the sample? So sample period. So in the sense that, was there any random chance that the income of the group that was getting reminders was somehow different afterwards? Would be something to ask. So maybe some kind of the dependent variable being something to do with the net effect after income, or sort of income flows as well being accounted for there might help to make it more precise. And the other question I had really was about like how people spread their money. So I don't know about this in South Africa, but in a lot of places people tend to have multiple accounts, and when you get reminded that you have some money in your account, you might decide to look for a better interest rate. You might decide to do something like say, oh, you know what, this is more money than I have, I want to invest. So we saw that during the pandemic, huge numbers of people went and created online accounts and started investing in stocks. So is there a possible sort of a question of degree where like they just sort out alternative investments? So I don't know how you would be able to capture something like that, but because they're just clients of one bank, that information might not be captured here. So I just thought that these might be some things to sort of potentially sort of think about or caveat in the results. That's all.
Yeah, no, that's true. Thank you for the suggestions. I on the first one on income, I have to think about it. I wanted to reply immediately that it wouldn't matter. We can look at income in a later period, but I'm so then maybe there may be kind of dynamic effects going on. So normally it wouldn't matter if some of the other variables would change here. But you may be right, of course, that if after 5 or 6 periods, income is going to change, which has an additional effect on savings, that something else comes in. But at the same time, what we do know, of course, because it's a clear RCT, the coefficient of the reminder on savings is unbiased. So I don't think that there is a problem as such. With respect to the other savings possibilities, that again will not change our results regarding savings at this bank. But it may be true, of course, that something else happened, that people start investing somewhere else. And unfortunately, we don't have this information. So we only have information from this bank, and even that is limited because bank information or commercial bank is always has privacy issues, so we cannot get income levels, for instance, at the client level, but only income groups. We don't have names, but more importantly for your question, we don't have information about what those clients do with their savings, because that would have, or whether they invested somewhere else. We cannot match with this information. So we haven't done any normal survey. So we only have the kind of administrative data from the bank, which mainly is income groups, gender, age, saving balances, and that's about it. More information we can't get. We can only get that if we do surveys, but this is a sample of 35,000 people, and we were thinking of sending out a kind of electronic survey, but then we would run into lots of attrition problems because a lot of people will not respond, etc. And doing a kind of real survey, going to people is not cost effective. You cannot survey 35,000 people. So yeah, that's unfortunate.
Thank you. Just a quick sort of follow up. So, is it possible that you could get deposit information? So, for example, is it there's reduction in savings coming from a reduction in money coming into the account or money going out of the account? That might be what I don't know if that helps, but
yeah, that is maybe something we could get. Yeah.
Okay.
Yeah, that is maybe something we could get. Because then we need to look at another account as well and see whether that matches. Yeah, that's a good suggestion.
Thanks.
Thanks, Jaideep. Super comments and good observations. Hong, you have the floor.
Yeah. Hi, Robert. Hi.
Hi, Hong.
Good to see you. And I like the paper. I think RCT is still something that that people got a Nobel Prize because of this. So I know you have been doing this, and that's very interesting. My concerns are, so you started with the rationality of agent, but maybe there are some behavioral factors here. So what I can think about, maybe the risk attitude of your agent or clients, and also how do people react to something like a constant reminders, for example. So my comment is really about, do you think those behavioral factors are relevant for your results?
Yes, I by the way, the basic assumption here in the models is that it's not rationality, because if there is rationality, actually what Victor started with, then reminders would not have a role. So the whole idea here is that we have non-rationality, yeah, and the behavioral thing which comes in is here not a behavioral type of model, but is inattentive and attentive models. So that's one thing. So it's certainly not a rational whatever model. Yeah. So the model which I sketched before was the benchmark, which gives you optimal utility, but that's what we assume not to be the case. Yeah? So a reminder can help you restore it. Now, other behavioral things, that will certainly play a role, but the question here is, will that affect the way how reminders work? Because of the fact that we did a randomized control trial, then you may assume that even if people have different types of risk attitudes, that on average, the risk attitude of the control group is the same as the risk attitude of the treatment group. So the question then is, how could the effect of reminders then be different? And yeah, maybe you have an idea here, but I don't think actually here that the effect of the reminder, if in this model, if we assume here risk averse consumers. Yeah, that's what we assume because we have a concave utility function. So we have not risk neutrality, we have risk averse. Now you may say, okay, maybe if we assume maybe risk loving consumers would change it. That may be a possibility.
Yeah.
That
Okay.
may be a possibility because then yeah, then some results may change. But that is a kind of a strange assumption to assume risk-loving behavior. But yeah, maybe risk neutral as well. So the basic assumption here is that we have risk-averse consumers. Yeah, and maybe, and then the other question is what maybe direction you're going. So would it differ if we have present bias consumers or such? So more in the, let's say, behavioral economics field. I don't think so, because then the present bias consumers will be both in the control and the treatment group, and then the role of reminders would still be the same, I think. But maybe once again, if we would assume risk-loving consumers, that the results may change. Yeah, that may be the case.
Yeah, okay, I trust you. So I have no idea. So I just, I was wondering, and maybe some other psychological factors. So I do not know, but that's my comments. Yeah, thank you.
So the psychological factor we brought in here is also psychological, because there are two psychological factors here. Is that the reminder makes you more salient, which is a psychological factor about the future expenses, about your savings goals, in fact. That's the basic idea here. And the other psychological factor here, which we brought in, is that the reminder may also make your kind of make your past, make your past savings more salient, so which kind of psychologically induce you a bit more to use your past savings. You could explain this as a psychological factor, but yeah. The problem always with this type of things is that, or not the problem, but is that we have to explain that the reminder works differently, because the if you bring in some behavioral kind of assumptions that will hold for both the control and the treatment group in the same way, and then the question is whether a reminder is going to work differently, and I'm not so sure about it. That's
yeah, okay, thanks. Yeah.
Thanks, Hong, and thanks, Robert. Indeed, I can see in the chat, Refire Malek has come back with an interesting observation and say, does the fact that the World Bank Global Poverty Database, which was released on about 9th of March, just about 2 weeks ago, or last week, confirmed that South Africa, the most unequal country in the world, perhaps raise questions regarding the representative nature of the sample, as well as the behavioral aspects of the vastly varying clients in South Africa, and simplistically, how many consumers are even in the position to consider savings if they are living in poverty or without internet connectivity. I think that's a good observation, Refire. And I think in that context that here on this last slide, by Robert, where he's saying that in a further extension of this work or completion of this paper, he's going to look at income groups and the different income groups. So your comment has come right on time of his continued work in this area. Yeah, the heterogeneity of income groups might be provide exceptional insight into this research question. Any further comments, observations? Yeah. Maybe Robert, let me try to understand one aspect. And I know you know this on top of your because of the many randomized control trials you have undertaken. So you innovate, and that because of the COVID restrictions, you have access to a database for clients in one bank, and with that data you can still do the randomization. I'm just wondering whether, say, assuming the COVID restrictions were not enforced, and you had access to go out in the field as usual, and collect the initial preliminary survey, that maybe you would be collecting data from clients of different banks. Yeah. So, these are consumer different banks. And I'm trying to think whether this would matter for, say, your baseline survey, or even for the final survey after the intervention. That the clients would be from different banks, and maybe these banks have kind of variations, in South Africa, and then you are randomized on that context, and what you get at the end is actually the impact of the intervention. Would that make a difference or not? Is that something that may come up as a referee trying to dig into your database, or perhaps it doesn't matter?
So you mean, would it be better to have clients from different banks? Is that the question?
I suppose maybe it may have been difficult to get access to the different banks' databases.
The problem, of course, is the problem is twofold, because you not only need to have access to a database of different bank bases, but you also need to get the banks to do the treatment. So the bank sends out, in our case, the text message to their clients. So you can only do that with different banks if both banks are willing to send a text message to their clients. Or we have to do that for the bank, but that is kind of an enormous time-consuming thing. So what happened here is that the bank sent for us on a monthly basis a text message to 15,000 clients. And to organize this with several banks, the first thing then, of course, you need to think about how are you going to randomize, if you could do that with more banks. So then that is a question of how are you going to randomize. Then the advantage of doing this is that you will have more external validity, in the sense that you have probably your sample would be more representative because you have clients from different banks. The disadvantage may be that if you don't randomize correctly anymore, that if you completely make a mistake in randomization, that you take the control group from bank A and the treatment group from bank B, and if the banks have completely different clients, then your internal validity, then you don't do a RCT anymore. So then the treatment effect will be unbiased. So in other words, it complicates matters enormously if you have to do this with more banks. So that's the main problem. And we were here in the fortunate position because Amy, she was leading at this bank a a research group at the bank. That was her job of doing experiments for the bank to increase savings behavior. So this was started with not with the study, so we kind of adjusted it a little bit to make it similar to a normal reminder studies as has been done with Carlin. But Amy is working at this bank, and her position there at the bank is do different types of experiments which can show us, the bank, how we can induce our clients to save more. Because in the bank will maybe make some money out of it, people save more. So we did many experiments trying to induce people to save more. And all the experiments we did so far, and that's coming back to Hong, was somehow based on behavioral finance ideas. So we did this one, but we did two other savings experiments as well. So your remark, Victor, is very valuable, but it becomes very complicated to deal with normal banks. That's the short.
Yeah. I think I agree with the observation, Robert. It becomes much more complicated, but even with that complexity, it may not generate any useful insight compared to focusing on one bank.
Yeah.
And I guess you're also right, because even if there was no COVID, your randomization could only take place within the involvement of one bank that may provide the intervention and the data collection. Yeah, absolutely fine. Yeah, great. Okay, let me see, check the chat room and also to see whether there are any further comments, interventions, observations, questions. No? Okay. So it gives me again extra pleasure to thank you, Robert, for sharing with us this absolutely interesting work and exciting our interest in this type of investigation. We look forward to getting a version of the paper when it is ready for sharing and a further discussion as we go in this network. So I thank you very much for your time, your very careful explanation of the issues, the discussion, and also I thank our colleagues who are here in this workshop, who have contributed the ideas, and all those, of course, who are here and have sacrificed their time. So I will use the reaction button in the chat, which showers me with a lot of thanks indeed. Thank you, Robert. Thank you all. And we look forward to meeting here again with a paper from our good friend Pasquale Scaramuzino.